Hello Internet, welcome to Making Money. My name's Eric and this is your Daily Dollar, our financial segment where I give you one lesson every day to help with your finances. We're still talking about investing. We're probably going to be talking about investing for a while here. 2 days ago, we did our very first lesson on investing, and that was 6 things to keep in mind, 6 things that will get you pointed in the right direction when it comes to your investing journey. And yesterday we talked about the first of those 6 a little bit more in detail, and that's setting up your investing objective. Very important to have a clear goal when investing. This helps you make sure that you stay on track, that if you know where you want to get to, and it can also dictate a little bit about how you get there. Again, if you're newer to investing, that objective may change. How you get there may change. And as we go through the other topics here, you might flesh out your objective a little bit more. Today's topic will probably help you do that a ton, and that is risk. Today we're talking about risk. So in investing, and again, when we talk about investing for our purposes here this week, we're talking about the stock market. There's a ton of different things that you can invest in. We're just talking about the stock market. So risk. What is risk? Risk is really how much you're willing to lose. How much you're willing to put on the line and it disappear and you be like, okay, I can still survive. Obviously, nobody wants to lose money. That's not the point of investing. But when we talk about risk, the 2 portions of risk are your risk tolerance and your risk control. Risk control. So when we talk about risk tolerance, we're talking about that again, how much are you able to lose? And when we're talking about risk control, it's okay, how am I going to manage my assets, my portfolio, so that I stay within my risk tolerance? So tolerance, risk tolerance. What is risk tolerance? How do we determine how much we're able to risk, how much money we're able to put on the line? Well, first of all, the thing that you should keep in my opinion, probably the most important thing is your time horizon. If you're young and you're just getting into investing and you've got a long time before retirement and your goal is to save up for retirement, then yeah, you've got a nice long horizon ahead of you, in which case you have the ability to, if you want to, take on more risk now. Now, obviously, more risk comes with more potential for reward, but it also has the potential of backfiring and you losing money as well. If you have a long track ahead of you, then you've got time to recover if something were to go not in your favor. But let's say you're close to retirement, you probably don't want to take a lot of risk because just like we said a moment ago, if something were to go wrong, you don't have as much time to bounce back. Now, keep this in mind because this is very important. Specifically, if you're someone who's just getting into investing and you want a quick win. If you're someone that, 1, wants to try to get money really quick in the stock market, or 2, needs to get money really quickly, you don't want to take on a lot of risk. I know that sounds strange. Large risk, large reward. I need that money fast. I want to put money in. And this tends to be where people start to think that investing is gambling. And if you're getting into speculative trading, yeah, it can be, I guess. But when we talk about investing, we want to avoid that kind of mentality, that kind of throw money in, come on, 22 black. We want to think more of a long-term investing, right? If you do need that money right away, you actually want to take less risk because if you need that money right away, you want reliable gains. So yeah, we talked about yesterday, there's kind of like that sliding from income to growth. You want to be closer to that income side. You want to be be investing in things that are more guaranteed. Yeah, they might not give you as much money, but at least you're not going to lose it in the process. So that's the first one. Time horizon is very big when we're talking about this. The second is cash flow. How much money are you able to put into your account? Now, granted, when we talk about cash flow and risk, Yeah, let's say somebody has a $1,000 portfolio, someone has $100,000 portfolio, right? If the person with a $100,000 portfolio invests $100 into something, well, that's not that much of their portfolio. That's what, 0.1%. I'm doing quick math. Apologize if that's wrong. But yeah, if they're investing $100, then yeah, they can take a little bit more risk with that $100. If someone with $1,000 portfolio invests $100, that's a larger percentage of their portfolio. So they might want to not take as much risk with that. Now, that's kind of looking at it from a dollar point of view. When we talk about assets and we talk about portfolios, percentages is really how we'll be weighing things. How much percentage of your portfolio will be in X sector, in X stock, because that kind of rounds it out for everyone. So yes, per dollar, you can take on a little bit more risk if you have a higher cash flow, a higher quantity in your accounts. Percentage-wise, it's really not going to change. The other thing when it comes to risk tolerance is how badly do you need that money? The money that's in your investment account. Is it crucial to you? If you lost it, would you not be able to recover? Much like your time horizon, knowing what your needs are very important. My current financial goal is a long-term investing plan. It's a 15-year investing plan, so long-term. Some may consider that a mid-term investing plan. But my investing plan is 15 years out. It is extra money that I'm throwing into this. I'm taking, I would say, a moderate amount of risk with my investing, probably closer to a low end of risk. I've been doing a little bit more conservative. But if I were to lose chunks of that, it really wouldn't hurt me because I have other means of saving for retirement. This is just additional on top of, everything else that I have. So yeah, I would be sad. I would not be happy about it, but I could feasibly take more risk with that portfolio because if I lose it, it wouldn't really hurt me that much. So having an idea of your time frame, how much money you're going to be putting in, how much you are able to lose, if any, is going to help you with your tolerance portion. So what about the control portion? Well, this is difficult because there's a few ways that we can control how much risk we take on in the stock market. The first thing is what types of stocks we actually invest in. You want to invest in reliable companies. Remember, when you buy a stock, you're buying a portion of a company. There's a real business out there that's making real dollars and cents by providing services or goods to people, yada, yada, yada. But the history of that company is very important. Do they have a good track record? Has their stock price been declining ever since they they opened? When we get into this too, we get into the stock's fundamentals. And this is where things get kind of tricky because there's math behind this and stuff. So knowing if a stock has good fundamentals also will tell you if it's one that you are able to safely invest in. If you are new to investing, you don't really know a lot about fundamentals, don't worry, we will be having some videos. But for now, take a look at the history of the stock. Do some research on it. Does it seem like a stock that's safe? Does it seem like a speculative buy? Avoid the speculative and go with the safe if you want to manage your risk a little bit more. And equally, not only what stocks you buy into, but how many different stocks you buy into. This is also true with how many different sectors you buy into. We're talking about diversification here. So another way to manage your risk a little bit is by diversifying. If you buy into a bunch of different companies, well, if one company bankrupts and you lose all the money in that one, yeah, that sucks, but you have your money spread out among a bunch of different companies. So you'll still be okay. Likewise, if, you were to buy into a bunch of different sectors, let's say, healthcare, finance, technology, this also will kind of even things out from large hits to different industries. Let's say the tech industry were to take a huge hit all of a sudden for some reason, and all the tech stocks dropped, right? Well, if you had all your money in tech, you would your money would go down the toilet. You lose a ton of it. If you were spread out among a bunch of different sectors, yeah, you'd take a hit, but you wouldn't take as bad of a hit. So that's really what diversification is. We'll get more into diversifying because there's a ton there, stocks, sector, correlation diversification. But we'll talk about all that in a separate diversification lesson. So we've talked about reliable assets, diversification, and then the last really good trick and something that you can start doing right now to help manage your risk is called dollar cost averaging. Basically what this is if you had, let's say $100, right? And you wanted to invest in stock A, right? You could take your $100 and invest right now in stock A. Throw that money in, and then it might go up and down and all over the place, right? Hopefully it would go up for you. Another way to invest that $100 into stock A would be every week or every day buy $10 of that stock. Now, the idea here is kind of like diversification, but having to do more with the stock price change within that stock. So let's say we started off at, stock was at $100, all right? And then we bought our one stock worth $100 on day one, right? And let's say that stock went up a little and went down a bunch, and then it went up a little, and it ended. Let's say it ended. Let's say it ended a little low. Let's say we ended at 90, right? So we lost $10 over the course of a few weeks. Well, if we would have bought $10 as the stock moved, it actually averages out the price more. And because of that, you can actually, depending on how it moved, you could actually still make money if it is lower than it started at. It may have gone down to like 50. If it was at 100, went immediately down to 50 and stayed there, if you bought $10 at 50 for a bunch of weeks, as opposed to buying that one at 100, yeah, you did pretty good. When it goes back up to 90, okay, now you've made money as opposed to losing a little bit of money. So spreading your purchases out over time will flesh out the price. It'll dollar cost average into the stock, and it will allow you to actually even out your money a little bit more. Yeah, you could miss out on some big gains, but you'll also avoid some big losses. And that's really what risk management is all about. So those are three really ways to control, reliability of assets, diversification, and then dollar cost averaging. And that's really what we're going to talk about today. There's a ton of other ways you can start doing it, but at least if you have a basic idea of what risk is, that should help moving forward. This is longer than I had anticipated risks to be going on about. Sorry if I mumbled and babbled for a while there. But I hope you guys enjoyed this video. I hope you guys understand risk a little bit more now. As always, if you're enjoying this series, please feel free to subscribe. Interested, how are you managing risk? Is there something that we didn't talk about today that you would suggest to others to look at if they wanted to manage their risk? Feel free to leave that in the comments below. And as always, you can hit me up on Twitter, link in the description. And I will see you guys tomorrow for another video. All right, guys. See ya.